Thanks to these, the world has become obsessed with taking pictures of just about everything. Our surroundings, our company, our meals, and of course ourselves. Ah, the selfie. Snapshots of ourselves have been quite the rage for some time now. But did you know there's a kind of financial selfie out there that captures your financial habits over time? That's right. The credit bureaus are taking pictures of your behavior, and I don't mean when you're out singing karaoke or photobombing a stranger. I mean how you behave when it comes to managing credit and paying your bills. A lender will use your credit score to determine how you manage your finances. They want to see if you're someone who typically pays your bills on time, whether you've had any late payments, or if any of your accounts have ever gone into collections. It's just one of the factors they consider when they're deciding whether or not to lend you money. Other factors such as income, repayment history, and how long you've worked with your current employer also come into play. Your credit score also determines the interest rates that you're going to pay on your mortgage. Generally speaking, the higher the credit score, the lower the interest rate is that you're going to receive. That's why it's so important to make sure your score is the best it can possibly be. Credit scores range from about 300 to 850 points, and the higher the score, the better. Typically, a score of 720 or more is considered excellent. A score between 660 and 719 is considered average or fair. A score between 620 and 659 is considered poor, and below 620 is considered bad. And trust me, there is nothing worse than a bad selfie. The national average FICO score hit 699 in April of 2016. That's an all-time high. While there are several different scoring models, Fair Isaac Corporation's FICO score is the most widely used model in the country. Your score is constantly changing, too. Why? Well, because your credit report is always being updated. Your score changes each time your credit card balance changes or you apply for a new credit card. It also changes whenever a creditor reports to a credit bureau an on-time payment, or most important, a missed payment that's more than 30 days late. In fact, just one late payment can cause your score to plunge 60 to 120 points, depending on how high your starting score was. In fact, it can take up to a year to recover from a single missed payment. So, the take here is that you should regularly check your report for any errors, make all of your payments on time, keep your debt relatively low, and only apply for new credit as you can handle them. Remember those snapshots of yourself and of your financial behavior? Do these things, and you can kiss those bad selfies goodbye.